What if I told you there's a company sitting on 46% of its market cap in pure cash, has never missed a single dividend, pays you a 5.6% yield just to wait, and the market is pricing its entire operating business at virtually zero? That's not a mistake. That's HRnetGroup. Welcome back to JC Project Freedom. And on this channel, we look for dividend-growing, cash-rich, owner-operated businesses trading below intrinsic value, what I call Engine A investments. And today we're doing a full institutional deep dive on HRnetGroup on the Singapore Exchange. Now I want to be upfront. This is a complex business. It's underfollowed by Wall Street. It's domiciled in Singapore, and it has nuances that take time to appreciate. So I'm going to take you through this step by step. How the business makes money, what the competitive moats are, what the financials look like over the last years, how I value it, and ultimately, whether this passes my investment framework. By the end of this video, you'll understand exactly why I rate this a conditional buy at current prices. Let's get into it. HRnetGroup is Asia's largest locally founded recruitment and staffing group. Founded in 1992 in Singapore, they now operate across 18 cities in Asia with over 1,300 staff, and they have never, not once in 33 years, closed an office or missed a dividend. That tells you something about how they manage risk. The business has two segments. First, Professional Recruitment. This is executive headhunting. Their consultants place mid to senior professionals permanently into companies. The fee is a percentage of the candidate's annual salary, typically 15 to 25%. This is a high-margin business, nearly 100% gross profit margin on the revenue earned. It only makes up about 9.6% of total revenue, but generates 45% of gross profit. In FY 2025, they completed 4,766 placements. Second, flexible staffing. This is the volume engine. They hire contractors onto their own payroll and rent them to client companies. Revenue is the billing rate. At any given time in FY 2025, they had 16,421 active contractors deployed. This generates recurring, annuity-like income, though at a thinner 12% gross margin. And then you have their emerging digital businesses. Octomate for workforce SaaS, Dowdo as an employer of record platform, Leaps for HR consulting, and Ease, their job app. These are early stage but worth watching. Let me show you what 6 years of numbers look like. Revenue has ranged from 433 million Singapore dollars in FY 2020. That was a COVID trough, up to 612 million Singapore dollars in FY 2022, the post-COVID boom, and has since normalized to 584 million Singapore dollars in FY 2025. That's a 3% increase year on year. Gross profit has been a more interesting story. It peaked at 175 million Singapore dollars in FY 2021, dropped to 122 million Singapore dollars in FY 2024, and recovered slightly to 123 million Singapore dollars in FY 2025. I'll come back to the gross margin decline. It looks alarming on the surface, but the explanation is actually benign, and it's one of the key thesis points. Net profit after tax went from 50 million Singapore dollars in FY 2020, surged to 73 million Singapore dollars in FY 2022, then compressed to 46 million Singapore dollars in FY 2024, and recovered to 52.9 million Singapore dollars in FY 2025, up 14.3% year on year. EPS came in at 5.21 Singapore cents for FY 2025, up 14.9%. And the dividend? 4.2 Singapore cents per share, a 5.6% yield at current prices, and the 9th consecutive year of dividend growth since IPO in 2017. Now here's a phrase I want you to remember. This business is cyclical but not fragile. Revenues dip with the economy, but the company never bleeds cash, never takes on debt, and never cuts the dividend. That combination, cyclicality with structural resilience, is exactly the kind of business Engine A is designed to find. This is a slide that stops most institutional investors in their tracks. As of FY 2025, HRnetGroup holds 362.8 million Singapore dollars in total investment assets. Breaking that down, 263 million Singapore dollars in cash at banks, with zero borrowings. 63 million Singapore dollars in MAST bills and DBS credit-linked notes, and the remainder in listed equities and other assets. Net cash, 336 million Singapore dollars. That's 45.9% of the entire market cap sitting in cash on the balance sheet. Now, why does this matter so much? Think about what happens in a recession. Most staffing companies start laying off staff, closing offices, cutting costs. HRnetGroup does the opposite. They keep every office open, they retain their consultants, and when the cycle turns, they take market share from competitors who retreated. They've done this consistently across 3 major downturns: the global financial crisis, COVID, and the 2022 to 2024 hiring slowdown. Each time, they emerge with more market presence than before. The cash moat isn't idle capital. It's a strategic weapon. This is the structural advantage that I believe most analysts completely miss about HRnetGroup, and it's the reason I think the business is genuinely defensible. The co-ownership model works in 3 steps. First, HRnetGroup identifies a top-performing consultant who has demonstrated the ability to grow a P&L unit. Second, that person is invited to buy an equity stake in their own business unit. Their own money, real risk. Third, they earn a share of their unit's profits, permanently incentivized to build for the long term. At IPO in 2017, there were 22 co-owners. Today, there are 47, managing 41 business units across the group. In FI 2025 alone, more than 10 new co-owners were added. The result? These are not employees who will jump ship for a 20% salary bump. These are entrepreneurs with skin in the game who built their client relationships over decades. Their clients don't follow HRnetGroup. They follow the co-owner. And the co-owner's economic interest is aligned with the group. This concept is similar to Warren Buffett CEOs. No competitor in Asian staffing has replicated this model at scale. That's a genuine moat. Let me quickly walk you through the geographic picture. Singapore is the anchor, 63% of gross profit, 64 million Singapore dollars. Revenue was down 2.3% in FI 2025 as the Singapore hiring market softened, but public sector contracts grew to 16% of the mix, providing a meaningful offset. North Asia, Taiwan, mainland China, Japan, Hong Kong, Korea contributes 31% of gross profit, 53 million Singapore dollars, and grew revenues 11.8%. Taiwan semiconductor demand and China recovery are the key drivers here. Rest of Asia, Malaysia, Indonesia, Thailand, and Vietnam added in September 2025 is still small at 5% of gross profit, but growing at 22% year-on-year. This is the frontier market growth option embedded in the stock. North Asia is the growth engine. Singapore is the cash cow. Rest of Asia is the future optionality. Let me address the elephant in the room. What does AI do to a headhunting business? I call this the talent iceberg thesis. Job portals show you only the top of the iceberg, the active job seekers. But the best candidates are invisible. They're performing well and not looking. AI can scrape every LinkedIn profile in the world, and it still can't replicate a headhunter with a 20-year relationship who can make a single phone call. And here's the counterintuitive point. As AI automates routine roles, the jobs that remain become higher stakes. The cost of a wrong hire goes up, which means the value of a trusted expert headhunter goes up. The numbers back this. IT and tech is 24% of HRnetGroup's business. AI-related roles are 12% of that segment, and growing at 24% per annum across APAC. AI is a tailwind, not a threat. Now let me run HRnetGroup through my Engine A investment framework. These are the 5 gates every dividend growth stock must pass. Leverage. Net debt under 3 times EBITDA. Result. Net cash position, negative debt. Pass. Dividend safety. FCF payout ratio under 85%. Result. Approximately 77%. 40 million Singapore dollars in dividends against 52 million Singapore dollar free cash flow. Pass. Interest cover. EBIT to interest over 3 times. Result. 78 times. Yes, 78 times. They have almost no debt. Pass. Pricing power. Gross margin stable over 5 years. Result. Gross margin is down from 30% to 21%. Flagged as watch, not fail. This is business mix-driven, more flexible staffing, less professional recruitment. Per segment unit economics are stable to improving. This is a cyclical trough, not structural damage. Dividend growth. 5-year dividend CAGR above 5%. Result: 9.3% CAGR since IPO, from 2.5 cents to 4.2 cents. Pass: 4 passes, 1 watch. This qualifies as a conditional Engine A stock. I use 3 methods to triangulate fair value. First, owner earnings DCF. I normalize earnings to 44 million Singapore dollars, stripping out volatile investment gains and declining government grants. Apply a 9% discount rate, 5% growth for 5 years, 2.5% terminal. Fair value, 1 Singapore dollar and 10 cents per share. Margin of safety at 74 cents. 32.7%. That crosses the full position threshold. Second, EV/GP multiple. Staffing businesses globally trade at 5 to 6 times EV to gross profit. I apply a 30% Singapore discount, giving 4 times. Add back 336 million Singapore dollar cash. Fair value, 84 cents per share. Margin of safety, 11.9%. Third, EV/EBIT multiple. Sector median is 11 times. I use 8 times. Add back cash. Fair value, 81 cents per share. Margin of safety, 8.6%. Blended at 60% DCF, 40% multiples, 0.935 Singapore dollars per share. That's a 26% upside from current prices. And the reverse DCF? At 74 cents, the market is pricing the operating business at near zero long-term growth. It's only paying for the cash. The business itself is essentially free. Looking forward, I model 3 scenarios. Base case assumes flexible staffing volumes grow 4% per annum. Professional recruitment recovers 5% per annum. SG&A grows at inflation, and other income normalizes to around 17 million Singapore dollars. That gives me EPS of 5.21 cents in FI 2025, dipping slightly to 4.81 cents in FI 2026 as other income resets, then recovering to 5.89 cents by FI 2030. Bear case, assuming a 2-year Asian recession, 3 Singapore dollars and 67 cents EPS by 2030. Bull case, assuming a strong hiring cycle, 8 Singapore dollars and 38 cents by 2030. Base case 5-year total return, including dividends, approximately 11 to 12% per annum. For a boring, safe, dividend-paying Asian staffing company, I'll take that. I always want to be honest about risks. Singapore's softness is real. It's 63% revenue, and the hiring market is cooling. Public sector contracts are helping, but it's something to watch. China and North Asia stagnation. 15% exposure, with recovery fragile. AI disruption medium term, mostly mid-level roles. Senior exec search is insulated. Other income lumpiness. Investment fair value gains and government grants are volatile. Always strip these from core earnings when evaluating quality. SIM family concentration. 80% control. The dividend track record is the protection here. Taiwan Strait. Low probability, very high impact. The cash moat is a survivability buffer. So here's my verdict. HRnetGroup is a conditional buy, half position now. The DCF gives 32.7% margin of safety, that above my full position threshold. But the multiples base valuations show a smaller margin of safety. My blended fair value is 0.935 Singapore dollars. The framework says, half position at current prices, add to a full position if the stock dips below 70 cents. Target range, 0.935 Singapore dollars to 1 Singapore dollar and 10 cents. For reasons to own it, zero debt cash fortress. Unique co-ownership mode. Trading cheap versus intrinsic value. And a 5.6% dividend yield, growing at 9% per annum while you wait. If you found this analysis useful, please like and subscribe. It genuinely helps the channel. Drop your thoughts on HRnetGroup in the comments, and I'll see you in the next deep dive.